So good evening, everyone. My name is Maurya Hanspal, and in this session, we're going to talk about capital structure in further more detail. So this session is capital structure number 4. So all the previous sessions, which started from capital structure 1 to capital structure 3, have already been completed. So let me recall in a very brief that what did we do actually from capital structure 1 to capital structure 3. Then after that, if you people still have any doubts, you people can go on through the recordings, like which are still available on the YT sessions only for the capital structure 1 to 3. So in the previous sessions for capital structure, we talked about what exactly is the capital structure of the company, what exactly comprises of the capital structure of the company, be it equity, be it debt, or the preference shares, and the various other sources of capital. Also, we try to understand how to calculate the cost of debt. We also try to understand how to calculate the cost of equity by using the most important and well-known model, the CAPM model, the Capital Asset Pricing Model, or the CAPM model. In that model, we try to establish an equilibrium relationship between the cost of equity and the systematic risk in the market. Systematic risk is nothing but the non-diversifiable risk or the market risk which cannot be eliminated away. And beta is a proxy of systematic risk, and we understood that. We also tried to understand the kind of differences between systematic risk and non-systematic risk. Systematic risk is called the non-diversifiable risk, as I talked about, and non-systematic risk is the diversifiable risk or the company-specific risk or relevant risk or unique risk. All means the one and same thing, which can be diversified by the company either through its management activities or by creating a portfolio. Then we further enhance the CAPM model by including the unsystematic risk or the residual risk or the error term in that equation. And we also included the size premium, and we tried to understand why the small cap companies or the mid cap companies have a higher potential to grow as compared to large cap companies. And then we also talked about the different types of beta. That is, beta greater than 1 is the aggressive beta, beta less than 1 is the defensive beta, and beta equivalent to 1 is the market beta or the beta of the index. So that we try to understand. Further, we also derived the graphical representation of CAPM model in the form of the security market line. And we understood what exactly is a security market line. And we also tried to differentiate it from the capital market line. And we also talked about the lending portfolios and the borrowing portfolios, and most importantly, the market portfolio, which is also called the tangency portfolio. So these things we tried to understand. And further, we also talked about the assumptions of the CAPM model, the most important assumptions of the capital asset pricing model. So all these things we tried to discuss in the previous sessions. So in this session, we're going to continue our discussion again on where we left, on the lending portfolio and the borrowing portfolio concept on the CML line. And of course, we also talked about the capital allocation line as well, which further transforms to a CML line later. Okay, so all these things have been done in quite detail in the previous sessions of capital structure 1, starting from capital structure 1 to capital structure 3. So people can go back and watch the recordings once you watch this YT live session. So in the previous session, we had constructed a graph like this. We also talked about the efficient frontier as well, like which was nothing but a C-shaped curve. And we understood the importance of that curve as well in terms of finance and designing your portfolio. And this was a line that was going here. And this point was basically the market portfolio or the tangency portfolio. And we divided it like basically, I just plotted, just got hang the whiteboard here. Okay, so here what you have, here you have your standard deviation or the total risk. Here you have your expected return. Okay, here you are having that C-shaped curve, which is nothing but the efficient frontier. Here by clicking on this line, this point, and then it goes high. So this point was basically the market portfolio, and this was your capital allocation line. We tried to discuss that, and we divided this into two parts. Like this part was your lending portfolio, and this part was your borrowing portfolio. Okay, and we tried to understand that. Yeah, great. Take care. So, like a lot of people ask me the difference between the capital allocation line and the capital market line. That what exactly is the difference between the capital allocation line and capital market line? See, there is no much difference between capital allocation line and capital market line. Both like represent the one and same thing. Both represents the combinations of both the risk-free assets and the market portfolio, which contains all the weightage of the risky assets. So capital allocation line or the CML line is one and the same thing. Capital allocation line in some way we can say is a part of the CML line. Okay. And this CAL line or be it the efficient frontier, as I talked about in the previous session, these can be different for different persons. And this is completely based on the concept of behavioral finance or financial psychology. A person can have an efficient frontier at a higher level or a lower level. But in the ideal case, we took it in this sense. Similarly, the CAL lines or the capital allocation line can also differ. Someone can have the CA line here and someone can have here. So different CAL lines are representing like different combinations of the risk-free assets and the market portfolio, which of course contains an optimal combination of the risky assets, right? So CAL or the capital allocation line can be termed as a part of CML line. Okay. But we can say at the extreme tangential point. At the extreme tangential point, matlab at the extreme of the market portfolio or at the extreme of the tangency portfolio, your CAL, it becomes a CML. So one difference we can understand, the capital allocation line is considered in terms of a narrower concept, has a narrower scope, whereas a capital market line has a broader scope. Because CAL line is just containing your risk-free assets and market portfolio. मतलब कि risk-free assets and risky assets का combination. Okay. But what is this CML is telling you? CML occurs at the extreme or at the extreme point of the tangency portfolio or at the end of the tangency portfolio. Okay. Though it might sound a bit absurd, okay, because they both mean like one and the same thing. So just for the sake of simplicity, just understand one thing, that CAL is same as the CML. Okay. Yeah. And we can also say that the point of intersection, of the indifference curve, like which we talked in the previous session, the concept of economics, the point of intersection of the indifference curve and this capital allocation line can also be called as the efficient frontier. So that is something like which we go in a more technical concept, but as to know, these concepts are enough for you to understand. Okay, so ज़्यादा deep में we won't go. Yeah. Now the question arises that what is the slope of this capital allocation line, or what is the slope of the CML line? The slope of this line is represented by a ratio which is called the Sharpe's ratio. And this Sharpe ratio is a very popular ratio which is used in the industry of mutual funds as well. One of the most widely used ratios in like mutual fund industries, the Sharpe ratio. Okay. So what is Sharpe ratio? Sharpe ratio basically tells you how much excess return you are making over the risk-free rate of return on the basis of the standard deviation. Okay. How much return you are making over the risk-free return on the basis of standard deviation. मतलब जो market में आपको जो return मिला है, because obviously you went into the market, you invested your money in the market because you are hopeful of getting a more return. In the market, you took a higher amount of risk. So when you take a higher amount of risk, you get a higher amount of expected return as well, but not in all the cases. But as for now, in this formula, RM minus RF is nothing but the excess return that you got over the risk-free rate divided by the standard deviation. Standard deviation is nothing but the risk of the market, the total risk of the market, which includes both the systematic risk and the unsystematic risk, both the diversifiable risk and the non-diversifiable risk. Okay. So, like a simple question can be asked, what is the slope of the CML line or the CAL line? In that case, you can say the slope of this line is the Sharpe ratio. Further questions can be asked on Sharpe ratio, and direct questions would be given to you. Like, for example, the return on market is 10 and the risk-free rate is 6. The risk in the market is 4. So calculate the Sharpe ratio. Okay, it will be just 4 by 4, 1. Okay, like similarly, like some basic values they will give you, like they will give you the rate of return on market, they'll give you the risk-free rate, and they'll give you the standard deviation. You just have to put it in this basic formula and calculate the Sharpe ratio. Sometimes they give you the final value of like Sharpe ratio, and they say calculate the return on market. Sometimes they say calculate the RF, or sometimes they say calculate the market risk. Okay. Instead of giving you the values of RM and RF, in the question they can also say you that the exit return is 4%. So exit return का मतलब भी यही हो गया कि RM minus RF की value दी हुई है. ठीक है. So that is one thing. So that was about all these concepts that we tried to understand. Now let's come to preference shares. Preference shares. Also, you have the concept of preference shares. But these shares are not completely like freely traded in the market, but these are some shares which are given to some specified people as a preference, and those shares are not freely available in the market. Okay, and obviously certain preferences or advantages, I can say, are given to these people. Advantages in terms of, like, for example, when the company declares a dividend, okay, the preference shareholders have to be paid first, and the equity shareholders have to be paid after the preference shareholders. They get the right of getting the first dividend. And there is a lot of confusion among the people. They think if the company has earned a profit, the company has to give a dividend always. No. If the company has earned a profit, it is not mandatory for the company to give the dividend, either to the preference shareholders or the equity shareholders. But if the company has like decided to give the dividend, company का profit हुआ, and company ने बोला कि I would be giving dividend, in that case the preference shareholders would be given the first privilege, and after that the equity shareholders. Also, these people do not have any voting rights as the equity shareholders. And also, when the company is going into for the process of liquidation or the company is winding up, okay, these preference shareholders get the first preference of getting their money by selling the company's assets. And after that, the equity shareholders are given. Obviously, the first preference is towards the bondholders in case of liquidation of the company. The second preference goes to the preference shareholders, and third to the equity shareholders. Okay. So preference shareholders they're called as an instrument, a hybrid instrument, which has the characteristic of both the equity and debt. Why equity? Because they get a certain amount of dividend, and why debt? Because they get a fixed amount of dividend, like no matter what. Okay. And also in terms of liquidation of the company, they get the first preference after the bondholders in terms of comparison with equity shareholders. Okay. So if you want to find the cost of preference shares, you have the basic formula, and the formula is same like just as the debt. You have the PD, like which is nothing as a preference dividend. In case of debt, you had this figure as the interest. Okay. This you can call it as the face value of the preference share or the redemption value. This you can call it at the price at which they are being issued, by the number of years, and again you have this. And the formula is just the same as we did in case of debt. PD, like which is the preference dividend. In case of debt, you had the interest. This face value or the kind of redemption value minus the price at which these preference shares have been raised by n, which is the number of periods. And then we are dividing the summation by 2. Okay, so let's take an example to solve this. For example, in the question, they say you that the preferred dividend is 15, face value is 100, price at which the shares were issued is 96, the issued for a time period of 10 years. Calculate the cost of preference shares. Very simple, just put in the value. 15 plus you have this 100 minus 96 divided by 10 upon 100 plus 96 divided by 2. Okay. So once you solve all this, you get the value of 15.71%. So that is the value that you get, 15.71%. That is the cost of preference shares. Okay. So similarly, like these questions can be asked to you. Like sometimes they give you the cost of preference shares and some of the mid value is missing and you have to calculate like any of the mid values. So that is just you have to like substitute the values. Okay. One last concept comes in terms of WACC. WACC. This is called the weighted average cost of capital. It is also called the overall cost of capital. So what happened in the previous scenarios, we were calculating the cost of equity separately, cost of debt separately, cost of preference share separately. But if anyone wants to know that what will be the total cost of capital while taking into consideration equity, preference and debt, then how to do it? So that is nothing but the weighted average cost of capital. You are taking accumulation of all this. Okay. So what do we do? Ideally, it is in the case of debt and equity we try to find out. So the proportion of debt as per the proportion of debt in the total capital structure into the cost of debt plus equity divided by the total capital structure into cost of equity. Equity. So cost of debt and cost of equity, we know how to find it. This is nothing but the capital structure. We are trying to find the weights कि debt का weight capital structure में कितना है. मान लो कि capital structure total 10 है and debt is 40. So the weight would be like 0.40 and equity would be 0.60. Similarly, we are trying to find out the weight of equity. कि पूरे structure में equity का weight कितना है. And cost of equity, we know like how to find it. Let's do a small example on it for clear understanding. Let's assume that the cost of debt a company has is 8%. Cost of equity is 15%. Company has a debt of 20 crores. Equity the company has of like 150 crores. And someone says calculate WACC. What you will do? Debt as a proportion of total, you're calculating weights into 8% plus equity as a proportion of total into 15% we are doing. And let's try to solve it. So this will be 20 divided by 170, 0.11 into 0.08 plus 150 divided by 170, 0.88 into 15. So when you try to solve it, you get 13.24%. So 13.24% is your cost, your overall cost of capital or the weighted average cost of capital. So it is taking into consideration the equity component and the debt component. In this case, we are assuming that the preference shares have been included in equity. But अगर preference shares included नहीं है, then this equation would be extended into some more. ठीक है, तो नीचे फिर 3 पार्ट्स हो जाएंगे. वन पार्ट वुड बी फॉर प्रेफरेंस शेयर्स, एंड लाइक इंस्टेड ऑफ हैविंग टू figures, like we'll have a third one, and third one would be for the preference shares amount divided by debt amount plus equity amount plus the preference share amount. If the company thinks कि मतलब कि treasury bills भी हैं and ये सब भी हैं, तो then another one can come up. That would be the treasury bills amount divided by debt plus equity plus preference plus treasury bills. And पुराने formulas में भी plus treasury bills add हो जाएगा नीचे, and उसकी value भी आ जाएगी. So जितने numbers हैं, जितने capital structure के proportions हैं, तो just accordingly take the values and calculate the rates. So that is one and the most simple thing which you people can do. So this was all about the capital structure, and with this we have finished the capital structure for today's session, and I'll see